recording, so that's for anyone that joins late. Good day and hello, and thank you for joining us with this Risk Readiness webinar. It's our latest installment in the Credit Trends and Commercial Lending presented by ProSite in partnership with AFS. During the presentation, if you have a question for Tom, please submit using the Q&A feature at the bottom of the screen, and we're here to help you if we can. So at this time, I'm going to turn it over to Tom Cronin at AFS. And as always, Tom, thank you so much for your insights and leading this webinar.
All right, thanks, Ann. And I hope everyone's enjoying the hot summer, at least here hot on the East Coast. We're going to do something a little bit different today. We're going to focus solely on credit quality and solely on C&I borrowers. And to do that, we're going to use our new Credit Risk Navigator webpage on risk migration. So I'm going to do a quick orientation of the charts. We'll discuss some of the macro results of what we're seeing at a high level. And then I'm going to dive into about 3 selected industries to give you a little more detail on what's happening with 3 industries that are seeing some drastic changes. So earlier this week, during our pricing webcast, my colleague Jeremy Charlson asked the question to the group, what are your loan expectations, loan growth expectations? And over 80% said they are expecting significant loan growth this year or in the next 12 months. And a similar percentage, said they expect fierce pricing competition. So in this ultra competitive environment coming up, it's going to be extremely important that you extend credit to the right companies and the right industries. Because for every $1 billion in loans, lending to an industry with a 1% non-accrual rate versus a 0.5% non-accrual rate will cost you almost $400,000 in lost income at an interest rate of 7.5%. And the risk migration charts and tables that we'll examine today will help you select the right industries or know which industries have a higher degree of risk and therefore will command higher interest rates. So before we look at the charts, I wanted to show you the RMA 10-point scale. And just very quickly explain what's here. If you can remember this, or maybe take a quick screenshot or capture, write this down, this will help as we go through some of the charts today. So on this scale, loans rated 1 through 6 are pass. And the loans rated 1 are substantially risk-free. These are, it says here, pinnacle of credit quality. I mean, these are the best. And then it comes on down to get to 6, which is acceptable risk with borrowers starting to show some below average credit quality, below average financial quality. And you're starting to get towards the bottom there. The 7 through 10 are what's called criticized. And these are companies or borrowers where something is happening with them. There's definitely potential weakness. Some of them, as you get even lower, there's even a more well-defined weakness. So if you could remember this chart, because we're going to talk about pass to criticize, and when we look at the matrix, we're going to look at 3s and 4s and 7s, things like that. So let me go over to the actual web page now. So a quick comment on our methodology, how we created this risk migration web page. We're examining 12-month periods. So today we're going to be looking at June 2024 versus June 2025. And this is at the borrower level, and the borrower has to be present in the beginning of the period and at the end of the period with a valid risk rating. So if, pardon me, a borrower was in the database in June 2024 but paid off in January, they are not in here. Similar fashion, if they were new to the consortium in January of 25, they are not in here. And if the borrower didn't have a risk rating when it joined, but does at the end of the period, they're not in here either. So it has to be in the beginning of the period and the end, and it has to have a valid risk rating. And you see up here at the top on the right, there are 4 ways to look at the data. The C&I count by borrower, or C&I net book balance, CRE borrower or CRE net book balance. Today, we're going to look at C&I count borrower. In the future, actually in August, we're going to look at the CRE dollars, CRE borrowers, but today we're just going to focus on the count by borrower. Let me go through each chart and kind of give you an idea of what's there. And I'm going to highlight each chart here. I'm going to put a spotlight on it. So this first chart is the pass to criticize to pass chart. And there's a column for each two-digit NAICS code. And again, we map every bank's native borrower risk rating to the RMA 10-point scale. 1 through 6 are pass, 7 through 10 are criticized. So the percent of borrowers that declined in credit quality and went from pass to criticize is in the red. The percent of borrowers that improved in credit quality and went from criticize back to pass is in the green. So that's our first chart. We'll come back to this and talk about what it means in a second. The next chart is the downgrade upgrade. So this chart, again, has a column for every two-digit NAICS code. And this is just based on movement in the rating. It doesn't necessarily have to go from pass to criticize or criticize to pass. So this could be a change from a 1 to a 2 or a 4 to a 3. So, and again, a column for each NAICS code. The downgrades are in the red. So that would be borrowers that say went from a 5 to a 7. The upgrades are in the green. And those would be say 4 to 2 or 4 to 3. So I'll close out this one. We'll go down to the next one. So as we add more time periods, this chart will show additional columns for each of the 12-month period, for each 12-month period. Right now, it's just the downgrades and upgrades for June 25 versus June 24. Again, you'll see more columns popping out here as we go along. Now I'm going to go to the upper right. Let me move this out of the way. This is our distribution chart, another chart that tracks movement. So the positive or to the right side is bad. So this is a rating increase. So this would be if a 5 went to a 6, that would show up here in this 1 category. The negatives to the left side are good. Those are rating decreases. So 7 minus 5, a little counterintuitive there. And the ones in the middle, so almost 87% had no change at all. So that's how you read that. All right. The next one is the matrix. And I'll explain a little bit how we did this and how to read this. If you go down the far left column, so here F risk can go down, these were the risk ratings as of June 2024. The row across the top is the risk rating as of June of 25. And the intersections show you what happened. So if I come here in the middle to 89%, this says borrowers that were rated a 5 in June of 2024, 89% of those are still a 5 as of June 2025. About 5% of those got downgraded to a 6, a 0.5% went to a 7, etc. We'll get a little bit more into this later on. This is one of the most important charts I think we have in here. The last chart that we have in here is relatively simple and straightforward. It shows the percent criticized for every two-digit NAICS. Now this chart, unlike the other 5, which are showing year-to-year comparisons, this chart is just for the current month. So here we're looking at criticized as of June 30th of 2025. Okay, so let's go take a look at some of the results now and see what's happening. And we're going to look at a macro level. And I want to start with the pass to criticized and criticize to pass chart. And I think what I'm going to do is show it as a table. I think this is just a little bit easier to see. Okay, so So what's this telling us from a macro standpoint, from credit quality? While you see reds and greens for every sector, um, the height of the red column is overall much greater than that of the greens. Most of the reds are above 2%. I think, a matter of fact, only three industries are below 2%. And none of the greens got that high, got the 2%. So to me, this indicates an overall shift downward in credit quality. You're just seeing so many more, a larger percentage of borrowers being downgraded. Let's go back then to the other downgrade upgrade chart. And again, I'll put this as a table because I think it's easier to see. And the results are very similar to what we saw with the pass to criticize to pass chart. Now, there are 8 reds that are at or above 10%. No greens are above 10%. So very similar to what we just saw, that the shift or the drift, if you would, is towards the poorer credit quality. Now, you do see here, though, a fair amount of upgrades for some industries, particularly like 55 management, some of the manufacturings. But overall, downgrades are outpacing upgrades almost 2 to 1. Let's go over one more macro level, come over to the matrix, and I'll put it as a table again. I think it's a little bit easier to see. And so we did this chart back in 2020 when we were working with the banks doing our CCAR project. And what we found then, and what we expected to see this time, were that the tails, if you would, should remain relatively constant. And when I say the tails, I mean like the 1 to 1s and the 2 to 2s, the 3 to 3s, and then the 8s, 9s, and 10s. Those shouldn't change all that much. If you put a loan in the doubtful category, it's probably not going to come, it shouldn't change that much. Very similar, if you say a loan or a borrower is at the pinnacle of credit quality, it shouldn't move that much. So that would be a 1. So what are we seeing? So at the lower end of the tails, so if you look at the 8 to 8, the 9 to 9s, and the 10 to 10s, it's pretty much holding true. 89% for the 8s, 84% for the 9s, but a lot of that moving in the 10. So that, pardon me, that's pretty much holding how we would expect it. I'm sorry. But the upper end, the far upper end, the 1s, 92% staying a 1. That was seemed pretty constant, pretty good. Although you do see a couple like 1% here, the 1s are now a 4. So that's a 3 rating drop. That's a little bit severe. But that's probably okay. Then you look, however, at the 2s and 3s and the little bit of the 4s and compare them with the 5s and 6s, and it really begins to is very surprising as to what's happening here. So the 2s and 3s both have 2-level drops of more than 10%. So you see that the 2s, 80% of the 2s came back as 2s. Let's say 8% dropped the level. But then here, if you see the 6 and the 3, so that's 10%, over 10%, went down 2 levels or more. And if you remember the chart I showed you, or the table I showed you earlier, I mean, these aren't the best credits. These aren't what they call the pinnacle, but these are the next best. These are pretty good credits. You rated these pretty well. And for them to drop 2 and 3 levels is quite astonishing. It's even more pronounced. The differences in my mind are more pronounced when you look at the 3s. And here you see you have almost 63%, or just 63% of the 3s stayed a 3. 22% dropped a notch. But again, over 10% went down 2 notches or more. And a fair amount went into the low pass criticized category. And again, these are the 2s, 1, 2s, and 3s are your best credits. These are really good credits. And for them to drop that much really tells you what's happening with the economy and how uh, banks are viewing their credits. The fives and sixes, on the other hand, 89% of the fives are still a five, so that seemed to be pretty good. So what I'm seeing here is that you might have been a bank, and I say you, I mean bankers in general, appear to have been overly optimistic about a year ago what was going to happen with some of their better credits and how they were going to get impacted by, the remains of the inflation, the high interest rates, the tariffs, all that involved. So there's been a dramatic shift in these good credits coming back down towards being more average. So let's go back and we'll take a look at some of these, a couple industries at a a little closer. And I'm going to look at the same three charts here. We're going to look at the pass, the criticized, the upgrade, the downgrade, upgrade, and then the matrix. So we'll begin with looking at 48 transportation, which is the highest one here. And I'm just going to hover for a second so you can see. So 48 transportation, most of this this is the category that has airlines, cruise ships, railroads, trucking, and then pipeline. Uh, you can't see it here, but I know on the other slides that the main issue here is for trucks. And, there's a couple of issues going on with trucking. The demand slowing down for one, rising operating costs, and then the other is driver shortage. A lot of people don't want to be over the road truck drivers anymore. So trucking, 48 trucking has the largest percent of borrowers going from pass to criticize at 5%. And the pass to criticize to pass ratio is also the highest at 5-1. And if we drill through here, let me drill through and we'll look at detail by borrower account. So here you see of the 48 loans that are 48, 28% are criticized. Here's our 5% pass to criticize. We'll get to the downgrade in a second. Only 1% going criticized to pass. And then you can see from a location standpoint, if you look at the state level, you see a number of states are New England-based states. So Maine, Rhode Island, here's New Hampshire, Massachusetts, New York, Vermont. So it seems to be a lot of problems for truckers that are domiciled in that location. So I'll go back. And so when you click on 48, it'll highlight everywhere else too. So here's downgrade upgrades. So 10% downgrades and only 4% upgrades. So a little over 2-1. If you come over to the matrix, and I'll show this as a table so you can see a little bit better. So this is the matrix for 48 transportation. The upper and lower tails sort of moving as we expected. 99.8% of 10s are still a 10. 100% of the ones are still a 1. And then everything goes out the window. 56%, 57%, 8% of the 2s are still a 2. You had 21% of those are now a 5. So that's a 3-notch downgrade in just a year. I think that really shows how volatile this industry is. The 3s are even worse. Only 39% of the 3s are still 3s. 30% of them only got downgraded a notch, so that's not too bad. But 21% went down 2 notches. You see another 5% went down to 6. And here's one that went into substandard. 7s, on the other hand, we know that most loans don't stay 7 for long. They tend to move one way or the other. And from the main chart, we know most 7s come back to be pass. But for the trucking industry, that didn't happen here. 61% stayed, but 21% got worse. 23, 24% if you would. So for the trucking industry, what this data is showing us is that this industry, from a credit quality standpoint, is turning towards the worst, to being one of the worst. Well, let's look at another industry. I'll get off of that. I'll go over here to 22 utilities. Oops, and I think I was there too long. So let me get back in. Hold on a second. I'll just refresh here. So what you're going to see here in a second is something very similar. It's not going to be as severe. So here we're on 22. So pass to criticize was 4%. Criticize to pass was only 1%. So not as severe, but for an industry that tends to be thought of as being relatively safe, this is a little bit concerning. I will tell you that most of the problems here in the utility industry is for solar panels industry stuff. Uh, there was recently an article in the journal about a large percentage of solar panel loans going bankrupt or going delinquent, not particularly related to this, but again, sort of similar in that that industry in itself is having some issues. If you look at upgrades, downgrades are 12%, upgrades are only 5%. So again, over 2 to 1. And when you drill through, here you see states with high percent criticized, Idaho, Kentucky, Minnesota, Illinois, Florida, Missouri. So a lot of Midwestern states, a little bit different than what we saw with the transportation. If you look at the matrix, and let me make sure I'm on utilities, and I'll blow it up again, show as a table. Here you have a little bit more stability, although the 1 going to a 2, 25%, probably not that big of a deal, but luckily it didn't go down more than that. The 3s stayed up a little bit higher, so this I think is more in line with what you'd expect. The one that's kind of puzzling or interesting is that the 7s, 46% stayed a 7, which is what we expect. We don't expect 7s, borrowers that are risk rated 7 to stay 7 very long. Unfortunately, of those loans, borrowers that were rated a 7, 31% are now an 8, so they went down. So this is kind of going the other way. The other one I'll mention, and just out of curiosity, if anybody has any idea why this might have happened. If you look at the 9, so the 9 is doubtful. That's something, that's just about ready to be charged off. Half of those loans got upgraded, but they got upgraded to a 7, which is special mention. And I thought if you'd had enough financial knowledge to say, oh, I'm no longer doubtful, I might actually make some money here, it would have gone into the pass, not into the special mention. But maybe if somebody has experience with this, I'd be really curious to hear from you what you have to say. So one more. I want to look at 72 and make sure I got it. This is 71. Here's 72. And a couple things here. Pass to criticize, 4% to 1%. You can see by the pie chart that almost half of the pass to criticize were loans, or pardon me, borrowers in the Southwest or the South. And then if you come down to the upgrade downgrade, downgrades were 8%, upgrades were only 4%. So again, a 2-to-1 ratio. And we'll go through and look here. 28% criticized for accommodation and food services. And most of this is restaurants. The restaurants have been sort of on the edge for a while now. This is definitely restaurants. A lot of this is restaurants. You'll notice that it's almost 12,000 borrowers. So this is a fairly significant industry sector. Probably one of the things that you don't get from any other benchmarking service. And the states with high percent criticized, so this is percent criticized, are a lot in the, you see Vermont, New Hampshire, the Midwest again. So even though the ones that are getting downgraded were in the South and the Southwest, the ones that are criticized or have been criticized are in the the Midwestern category. All right. So let me go back to hold on one more second here. Oh, I'll do the matrix one more time. So here's 72. I'll blow up the matrix. And so this is one last time for my what are you doing rant when we look at the twos and threes. The twos, dropping a notch is probably not bad. So 61% to 33%, probably not bad. But it's still a third of the borrowers declined. The threes, I think, are even a little bit kind of a perfect microcosm of what we've seen for the entire C&I portfolio. The banks rated these loans 3, which is very good loans, very good borrowers, and over 30% of those got worse. So you can see how the credit quality overall, specifically some of these industries we looked at, but overall are being impacted by all these economic factors that are weighing down. You've had the high inflation, the high interest rates, and then the uncertainties with the tariffs, and it's just really dragging down the credit quality of these loans of the borrowers. I'm sorry. Okay, so I'll go back to set up to the beginning. So that's what we had today for June 25. If you'd like to see more of CRN or perhaps a given industry, please email me. Next month, we're going to do the same thing that we did today, but we're going to look at CRE, and we'll be looking at credit quality by property type. And so let me go back and put up our emails. Whoops, went too far. Right here. So again, if you want to see something, or if you had another question, feel free to either email myself or Ann. And Ann, I'll turn it back to you for questions.
Sure, it looks like we do have a question or two. So the first question is, generally speaking, how many companies are in the data universe?
So there are over, I'm trying to think, we have 600,000, I guess is probably, I'd say 600,000. There's over $1 trillion in exposure and about 600,000 customers.
Great, thank you. And then the second question is, are SBA 7A loans built into these numbers?
The answer to that is yes. There are some SBA loans in here. There's not a lot. I'll be perfectly honest with you. There's not a lot, but they are in here. There's not in what you saw today, but in the other slides, there's the ability to break out loans, borrowers by business banking, line of credit, and then product, which has SBA as well. So that ability is there.
Great, thank you. Those are the two questions we have in queue. I can give it another minute or two to see if there's any other questions that anyone else would like to enter. This is one feature where I wish I could see if there's like a typing even, just some type of so I would know if there is anybody typing. Okay, I think that might actually be it. So Tom, thank you so much. This was interesting, a little bit of a twist, but definitely got us a deeper view into into what is available and also some insights, especially in those industries that you highlighted. Just want to say thank you to everybody for attending, and we look forward to seeing you next month.
Thank
Awesome.
you.
Thank you. Thank you. This concludes our webinar. Thank you.